there are some fascinating and challenging things happening in the financial arena with uncertainty over interest rates, market trends, and if we've watched the stock market the last two days, I try not to watch every day, I only watch when it goes up, investment opportunities. So to examine some of these trends and the outlook in financial markets, we're pleased to have with us a Vice President and the Senior Investment Officer with First Interstate Bank. Would you please welcome Rick McCann?
Thank you very much. Boy, isn't this a great venue? There are a lot of you out there, though, again today. It's just like last year. Get rid of Paul's water there and get ready to go here. Just by a show of hands, how many of you were here last year and landed your plane successfully in 2006? Ah, some did. Good. Well, we're going to pick up a little bit on that theme this year. We're going to look back at what's happened in 2006, and I'm going to bring you some information with regards to how our asset management team sees 2007 and perhaps looking into early 2008. And we'll begin that by looking at what the markets in general did in 2006. The equity markets measured by the Wilshire 5000, the total value, if you will, of all equities in the U.S. markets were up in excess of 15%. Most of that occurred late in the year and may well have been led by a couple of liquidity issues. I've written in my notes as I've been listening across the state this week, a lot of money has probably been withdrawn or is not aimed anymore at the housing markets, which may be an indication that that money has to find a home somewhere else and may well have gone into stocks and other speculative investments. In addition, there was considerable amount of private equity finance and merger and acquisition activity in the latter half of 2006, which has a tendency to affect the returns on stocks. Again, it's more of a liquidity-based push than it is really the fact that that there's been a significant change in earnings. Earnings actually are coming down in corporate America. We'll talk a little bit more about that. Cash was the second best performing entity last year, and that's because the Federal Reserve continued to push up interest rates through the first half of the year, through the end of June, and completed their 17th consecutive increase at the end of June 2006, which pushed the Fed funds target rate to 5.25% from its low of 1%, which was the level in June of 2004. So cash was king, if you will, except for the late move in equities. And the bond markets, which react negatively, as we remember from last year's education session, when bond yields are increasing, the value or price of those bonds that are in the market declines. So there was some offset to the coupon income that we saw, and bond markets returned a little better than 4.3% last year, but all were positive. Taking a look now at the segments of the market, the equity market specifically, and how they performed, really to no great surprise, I guess, the real estate investment trusts that are located in the U.S. market, most of which now are in the S&P 500 if they're of any substantial size, had one of their better years. And again, we didn't see the crack in the housing market until probably early in 2006. And so many of these projects had been financed in the lower rate environments of the prior 2 years and were returning very high cash flows. But of course, as the housing market has turned down, there has been more discussion about, will this outperformer continue? Secondly, you see emerging markets and international investments moving from left to right. They had another excellent year, partly as a result of some decline in the value of the US dollar, but also because the economic growth engine really had not been in the US. It was in places like China, India, and some places in South America. The next section of 5 bars is really the components of the S&P 500 and then smaller cap stocks. And again, we'll talk a little bit more about that, but the S&P 500 had an excellent year, and we'll talk a little bit about the different weightings there. Let's turn our attentions for just a few moments to the fixed income markets, or bond markets as they're most often called. And again, short-term treasuries outperformed longer-term treasuries with negative returns in the 30-year treasury environment, again, because they're most impacted by the increase in rates and the loss in valuation. When we look at the yield changes that occurred last year, if I can get this thing to move to the next slide, of course, the prime rate and the Fed funds rate moved up by 100 basis points. That will tell us, I guess, that there were 4 increases in the first half of 2006, and most of the other areas of the curve did not react as significantly, and it did result in the inverted yield curve that, again, we discussed last year. And as you know, there was quite a bit of dread or concern about that as the yield curve inverted, because we've always had recessions in the U.S. economy preceded by an inverted yield curve. But every inverted yield curve has not resulted in a recession, and we think that this is another one of those times where the inverted yield curve, with short-term yields being higher than long-term yields, will work its way through the system. And I guess that's best reflected here. Here's a look at the yield curves as of the end of 2005 and then again at the end of 2006, and you can see that short-term interest rates are significantly above long-term interest rates. Most of that occurred on the short end of the curve, where the Fed was pushing up the Fed funds rate. When we look at the bond markets, we're not only looking at Treasury securities, although that's where we focused our attention until now. Now we're looking at components of the bond market, and we have high yield investments, which had an excellent year last year, really based on 2 factors. One, there was continuing growth in the economy, so there was confidence. Investors were willing to take a little bit more speculative risk. There was probably another factor that may have played into this, and that is that we've seen a significant tightening in the spreads between these lower quality fixed income investments and treasuries. And when I was looking at some data earlier this year, basically the spread between treasuries and these high yield bonds, junk bonds as they're sometimes called, was about 280 basis points, or about 2.8%. That's a fairly low level. Normally they run between 350 and 450 basis points. So undoubtedly there was some liquidity flowing to this market in search of higher yields. And so I think that's probably what led to the outperformance there. As you can see, the other elements of the investment grade markets performed nearly the same in the 420 to 440 range. Just for picture purposes, here's the 10-year Treasury note yield, U.S. Treasury note yield over the last 10 years. And you can see that we did reach a bottom below 3.5% back in 2002. And the more dramatic change has been, of course, in the 2-year Treasury. Again, the Federal Reserve only controls the short-term area of interest rates. And typically we see some increasing, following of those rates as we move into the shorter area of the curve from the long area of the curve. Let's take a look at some economic data. And this is beginning to take us into an arena that I think is very important. Exports have become a major element of the U.S. economy. And that's positive in that there's higher levels of growth in other parts of the world. And so U.S. companies are exporting greater amounts of goods and services than we've ever seen them do before. And this was actually an engine that kept the growth rate of the U.S. economy probably at a higher level than it would have been had we been more based on domestic. Coming across, the second one you see is business spending, and I'm going to talk a little bit about that because, again, that's another engine. When we look at U.S. GDP, you and I as consumers create 70% of that growth in gross domestic product. So if we exit the market, if the U.S. consumer just flat says, I'm not going to buy anymore, that's a dramatic impact on GDP, and it doesn't take very much. Business spending, government spending are some of the other elements, and those elements are less weighty, but they have also helped us support. You and I as consumers did not exit the markets. We probably pulled back our spending a little bit. We'll see some consumer spending data in some of the information that's coming out that suggests that we're not buying at the same pace as we were 2 or 3 years ago, but we are still positive. I think increases in retail sales are still running around 5% on a non-inflation adjusted basis. So those exports that are guiding our economy and helping us kind of avoid potentially a bigger downturn are being led because the rate of growth in the global economy is greater than the U.S., and that's indicated here. You can see that the growth rate, GDP growth rate in the global economy is about 5% versus a little bit better than 3% in the U.S. economy. So exports are helping us. The decrease in the value of the dollar versus other currencies is also a positive. It makes those goods and services cheaper for those exporting countries, the countries that we're exporting to and they're importing U.S. goods. It makes them cheaper to them and more attractive. Now, one of the reasons that the stock market did so well was because we were coming off of several successive years of very high earnings growth in the S&P 500. And we're seeing that wane a bit. But it was pretty amazing when we saw 21, 18, 15% returns in the S&P 500 over the past 5 years, and yet we were only seeing 8 to maybe 12% returns in the index. If you looked at it on a purely academic basis, you would expect that increasing earnings at a corporation divided by the same number of shares would suggest that if you have positive earnings, the value of the stock would rise by the rate of earnings growth. We actually had growth in the stock market in terms of valuation change that were below earnings. So corporations were using that money somewhere else. If they're not paying it out in dividends and they're not reinvesting it in new plant and equipment, then they've got to be putting it somewhere else. So as those earnings slow, our expectation is that the stock market may not do as well as it did last year, but it's not all positive, or not all negative. Look at the cash balances that exist on U.S. corporations. This is a tremendous source of liquidity. And most of the documentation and most of the reading that we've done on corporate America is that their financial statements are in the best shape in a long, long time. That's a very positive, and it also suggests we're not the end of an economic cycle. We're most likely in a correction phase at the middle, and that there is still some room to run. So these corporations have built up huge cash balances, and that's allowed them to do such things as investing in their own company. How do they do that? They buy back their own stock. So how many times have we read in the financial press over the last couple of years that XYZ Corporation is purchasing back billions and billions of dollars of their own stock? And when they do that, they're benefiting the existing shareholders because they're reducing the number of shares outstanding. If they dispense the same number of dividends divided by fewer shares, what happens to our dividend growth rate? It goes up. And that helps the value of stocks. So there are a number of things that are kind of supporting the market and suggesting we're not facing a cataclysmic event, we don't believe, in terms of the stock market based upon earnings, based upon cash and liquidity balances, and based upon the financial status of corporations. Most likely, if we're going to suffer, it's going to be because something happens cataclysmic, either here or somewhere else in the world. Remember back to 1997 and 98. Most of this liquidity has been around for a long time. 97, we had a default on a Russian bond. 98, we had the collapse of long-term capital management. And then we had this little thing called Y2K that nobody talks about anymore. I was running an operations unit at First Interstate at the time, and it was a major issue for us. But I also know that the Federal Reserve, starting in 1998, increased the liquidity in the U.S. financial system substantially in order to avoid a cataclysmic event of computers not operating and you going to the bank to get cash on Monday morning. That didn't happen, and that liquidity has been drained, and some of the increases in Fed funds rates over the last couple of years have really been a reduction in that, although monetary growth rates have not decelerated very much as a result of the Federal Reserve rise in rates. Small caps outperform large caps. If you're going to mark me with a black mark for last year, we expected that large caps would outperform small caps, but we also did not expect that the market would have the kind of growth expectation that we saw in smaller caps. And again, most of these exports are coming from large cap companies, so that'll kind of guide us to what our outlook is for next year. For 2007, I guess that's this year, isn't it? The outlook for large cap, we think it will outperform small cap this next year, and I'm going to base this on a couple of specific elements. Line number 2, the profit margins of large cap companies are significantly above that of small caps. And the second one is the price earnings to growth ratio. So in other words, the dollars that you're paying towards the growth that you're getting from those companies is a little bit lower in ratio 1.3 versus 1.8 in small caps. That's just a valuation indicator, and it isn't a market timing decision as much as it is there appears to be some potential in those growth stocks which tend to, again, export more of their goods and services than our smaller companies that tend to be more domestically oriented. Right in the middle of that, you will see that large cap companies have sales outside of the U.S., this is as measured by the S&P 500 stocks, of 36% of their revenues. And the small caps, of course, are about 16. So that's another reason, again, we're kind of making the case for an international focus. And we'll, again, provide you with some ideas on how you can do that. Value stocks also outperform growth stocks. Value stocks tend to be higher in terms of their payment of dividends. They also tend to be financially oriented. Margins of banks remain relatively high in spite of the rise in interest rates, which is normally a time of compression in the interest rate margin of banks. But I think the bigger risk lies ahead as the interest rate markets turn over, because the cost of liabilities will not decrease as quickly as the asset base will. And many borrowers have been, according to our bankers, have been trying to extend the duration, if you will, of their liability side. In other words, trying to borrow longer term fixed rates. And it may well be beneficial for them to do so, especially if rates were to continue to rise, although that's not what we see in the horizon near term. We think also that value stocks probably will underperform growth stocks in 2007, primarily based again on some major factors. Sales growth is greater, growth companies, and specifically their profit margins are better. So we think that as the economy continues to expand globally, that again, these growth companies will have improved performance this next year. Sector returns during 2006 showed us that telecommunication stocks outperformed, which I will have to say surprised me, but there were two major acquisitions announced, actually three. But SBC purchased AT&T. AT&T then purchased Southern Bell South. Got them turned around. It must be dyslexic up here on this podium this morning. Bell South late in the year. And then Verizon also did some significant activities during the year, expanding their wireless program and ridding themselves of their wireline process. Those things led to tremendous increases. And of course, the telecommunications industry had been in a virtual vacuum since 2000 as the tech bubble burst in 2000 and 2001. And energy, as expected, was number 2 on the list. Now, as we look forward to 2007, we've gotten some projections of earnings in 2007. And again, overall, we expect the earnings of the S&P to fall somewhat from probably that 13 to 14% level that we'll see through 2006 as these earnings are announced this week and next, but also only down into the 8 or 9% rate of growth in earnings. So it's not cataclysmic, but we are seeing some change in where that's coming from. And I would point you to the right-hand side of this graph as you face it and look at the consumer staples section versus 2006 versus 2007, industrials, and also look at information technology. Again, we expect that these are the types of organizations that will expand substantially. So of course, those are the sectors that we would lean towards when we're making domestic investments. And we would also focus on those companies that have substantial amounts of their revenues and earnings coming from overseas. Overall, we expect that the U.S. budget deficit and trade deficit will likely decline. I have a little bit of a sense of concern about the budget deficit. I think tax receipts will be lower in 2007 as earnings growth slows and as a number of the spending programs really get some, we'll call it some fuel to their underside here in 2007, 2008. I think there is some risk that government spending may expand. That won't be totally bad, but it does lead to some possibility that interest rates would continue to rise as the supply of bonds were to be increased by the Treasury. We expect the unemployment rate, which is just phenomenal, and again, a kind of another indication to us that we're not at the end of a cycle. We're in a mid-cycle correction. Unemployment rate running in the mid-4s probably will edge up towards the 4 3/4 to 5% range, we think, by year end. Small business growth of businesses, of jobs specifically, has been declining, and we think that's an indicator of what will come. We don't expect energy prices to plummet. We were surprised by the $50 oil that we saw a week or so ago, but in listening to the news this morning, I don't have to worry about that anymore. It's pushing back up towards the mid-50s and maybe even towards 60. And I see that the Global Insights Group, which has some information in Dr. Polson's information in your books, indicates that they're expecting oil at $60 to $65 a barrel. And although that's probably a little bit higher than we would anticipate, we're clearly not pickers of energy prices. But it's now moving in line with demand. So as China demands more oil to build roads, to make asphalt, they're not using it for fuel in their cars. They're using it for asphalt to build these roads out in those infrastructure systems. I think the demand for oil will continue to be strong. And when we do have cold winters, which shouldn't be that unusual, but have been recently, I think that energy demand will also be exacerbated by that. Fed funds rate currently at 5.25. We see a low probability that it would move higher. If it does, probably only 1 or 2 more bites, and it would be because economic growth is greater than 3% and inflation remains above 2. Those two factors are things that the Fed says it will fight, so it may push on the brakes a little bit harder, but we don't expect that. We also do not expect the Fed to lower rates. An interesting analysis is when the Fed reached the bottom in Fed funds rates in 2004, that rate had been in existence for about a year. And we're just now coming up on a little bit over 7 or 8 months at the current rate. So it doesn't suggest that the Federal Reserve moves in a V action or the counter of that in the top end. So we would expect a kind of a period of plateau at the end, and it may end towards the end of 2007, and I think that's what most of the market pundits would tell you. We think that the Fed funds rate will possibly drop by 1 time in 2007 and then another time or 2 in early 2008, because we think economic growth will slow into the mid 2% range this year. Foreign growth continues to exceed U.S. growth. That's a positive theme for investments. Again, it's demand-led. There's a lot of liquidity there. The concern there is that foreign countries and foreign investors who have purchased a lot of U.S. dollar-denominated assets would repatriate those. That could create some anxiety. Most of that has been in Treasury securities. And how do they buy oil if you're in China, or if you're in Africa, or if you're in Japan, or if you're in Europe? You buy it in dollars. So we think a lot of the demand for U.S. Treasury securities has been based on the fact that as oil prices were high, you had to have dollars to pay for that oil when it was delivered. So they did it in the form of purchasing U.S. Treasury securities in order to pay for that. And we think that may well continue. We are excited about the continued growth in China. We know that they have the Olympics in 2008, and I don't think they want to fail. So I think that that demand is pretty solid for the next couple of years. But as Paul has said, and I would reiterate, China is not a raging democracy. And I think there are some risks investing in that particular part of the world, but it should only be a part of your portfolio anyway, because we talked about diversification a year ago, and I'm sure all of your investment advisors are telling you the same. So we're riding a liquidity wave, and the markets look to be pretty positive for 2008. And we're kind of excited about that. We think that the outlook domestically is that industrial companies, consumer staple companies, and information technology companies will outperform, and that some of the consumer-led, the discretionary type things, might be the downside. So that would be my report for 2007, and I would ask if there are any questions or comments.
Questions, comments?
Yes?
Are your slides available?
Yes, I can make them available. They, like I said, they kind of come out of our billings group. They don't come through the Bureau, but why don't I have you get in touch with me and I'll get those to you, okay?
Second, why the reduction in telecommunications?
With the reduction in earnings that we showed. Again, I think it will be a while before the effects of these mergers and acquisitions will be positive. I think there are some things happening around telecommunications, the move towards cable and those sorts of things that will be positive. But we just kind of think that the exotic growth that we saw last year will take a couple of years for them to re-engineer, to cut jobs, and to basically be able to return those dollars to the bottom line. We're not projecting a large drop in revenues. It's more just the margin, if you will, as they try to squeeze out some of the costs that were probably evident to them as they considered these mergers and acquisitions. Other questions or comments? Yes?
Can you expand on your comments on potential effects of tightening international supply, specifically as it relates to domestic interest rates?
Yeah, I'm sorry, I missed part of the early.
What was the question? Could you comment on the tightening of the international money supply as it relates to U.S. interest rates or interest rates in general? U.S. interest rates.
If in fact, as some of the other information that I have, foreign investment has been a reason why our valuations have gone up and our interest rates have been held lower, if that liquidity push, if you will, is helping us, then if that liquidity were removed for some reason, there would be some fear, I think, in the U.S. markets. I'm trying to remember some charts that I have for another presentation that I've done, but I think that about 30% of U.S. Treasury securities are owned by foreign investors. If that 30% of U.S. Treasury securities were repatriated to the U.S., we would not have the kind of liquidity at current rate levels to take that in. So that would cause a decrease in price and an increase in yields. So if there were to be a liquidity squeeze placed on U.S. assets and U.S. interest rates, I would expect rates to rise higher than we might expect. Again, it's more of a supply issue, not a demand issue, and it may be exacerbated or it could be helped by the fact that international demand for U.S. dollar assets may continue to be strong, especially as economic growth continues to expand elsewhere. That get to kind of your question? You're welcome.
Time for one more question, comment. If not, thank you, Rick.
Thank you.
Well, we recognize that there are a lot of things going on in local economies that are not always immediately available to us, and in particular the specifics of which are not immediately available to us from the economic statistics that we have to work with. And as a result, we've turned to local expertise to more fully develop our look at the Missoula area economy. And in Missoula, as many of you know, there is a very major development which has rapidly unfolded in the last year or so and continues to unfold. That is the arrival of DirecTV. And to talk about the DirecTV developments and some of the potential economic impacts of DirecTV, we have with us someone who was heavily involved in bringing DirecTV to us and helping to put together the deal that brought DirecTV here. We have with us the director of the Missoula Area Economic Development Corporation. Would you please welcome Dick King?
Thank you, Chuck, and I want to thank the Bureau for inviting us again to share some insights and lessons with everyone this morning. Also like to thank First Interstate Bank for their support of this event. A great turnout this morning. What I'd like to do today is give you an update. We promised last year to come back and give you a progress report on what had occurred, since at this time last year we were just starting a project and construction was just beginning. So I want to give a quick progress report. I've got two of our staff here. Eric Hansen is going to give some detail on the sources and uses of funds that went in the project. Jessica Aldred will discuss a cost-benefit analysis of the DirecTV project. And then I'll wrap up with a quick overview of some lessons learned and some goals for the future. Again, our objective this morning is to assess the status of this project and based on the lessons learned, what are some key goals for the future. So one outcome that I hope today is give you a good understanding how this was put together, and then encourage support for the key program that made this project possible. There are a lot of other things go on which we'll go through, but there was one source that I want to highlight here since it is being discussed by a few people in Helena as we speak. These people were amazing. They did what they said they would do. They constructed a 72,000 square foot facility in 7 months. Missoula County completed the purchase of that facility, the 12 acres, and the building in December 2006. So Missoula County now owns this facility and has leased it to DirecTV. The company has created 790 jobs as of the end of the year, and total payroll generated by operation in 08 is anticipated to be a little over $50 million for that year. The total project cost was a little over $23 million, and I'll run through quickly the state support and the other involvement, and then I'll turn it over to Eric to give you more detail about sources and uses. State support was key in two areas. They helped with the acquisition of the property once DirecTV had completed construction, but more importantly, they assisted with job training, a critical component that I'm going to hit again. The county support for the project was pivotal. Without it, we wouldn't have gotten anywhere. I believe Gene Curtis is here representing the Missoula County Commission. Gene, want to stand up for a minute? I also believe Dale Bickle is here representing the county staff. Dale, are you here? Somewhere in the room. Anyway, please express your appreciation to both of those representing the county commissioners. And the project put a lot of stress and a lot of hard work was done to make it possible, and it had to go through the county. So it's sort of like that fisherman in The Old Man and the Sea, you know, you put out the bait, you catch a really big fish, and then someone's got to make it work. And the county did that, and for that, they deserve our thanks and appreciation. The county support was critical. The county created a technology tax increment district, the first time that this has been created in Montana, and still the only technology tax increment district in the state. That was a new law, was passed in 05. The county also provided land. They created a very innovative program called Job Creation Credits, which after 10 years can make funding available for performance by the company, and they provided tax increment bonds. Federal support included a grant to the county for infrastructure in the technology district. I want to talk, the tax increment program is critical. The technology tax increment is the same as an industrial tax increment district, but is targeted toward high-tech companies with 50% or more sales from out-of-state customers. The DirecTV project, again, is 12 acres, but the whole project was 38 acres, so we have 26 acres remaining in the technology park to develop, and we're hoping to attract other companies from out of state and also companies in Missoula that can expand to that park to fill it out. One thing to stress is that we're able to do all of this without any county tax money being used to support that. The bonds and the job creation credits are coming through the tax increment program and payments in lieu of taxes. Even though DirecTV is leasing the facility, They will make payments in lieu of taxes the same as property taxes. Now for the hard part, I'll turn it over to Eric Hansen and go through the sources and uses of funds.
Well, this project, as you know, there's three of us up here, so it takes three of us to try to explain it all to you in within 15 minutes of time. But primarily, when you look at the slide, you'll see a lot of alphabet soup, and that's why Dick put me up here to try to explain every acronym known to man. Now, we could spend an hour doing this, but to try to summarize everything on how this actually worked, you have to kind of go back and say, well, there's three of us up here explaining how this really got put together, but it was a team effort with MADC, the county, the state of Montana, and DirecTV. You had three different types of agencies and companies working together, and that kind of equated to different cultures working together, and then actually coming at the end to figure out how to actually communicate with each other. And with all that, we came up with about a $23.3 million project. And if you look at the first thing I think we should highlight is you look at the Montana Board of Investments where it says MTBOI. You'll notice that there's a loan for about $10,040,000. Now that is a loan that obviously went to the county, and in order for us to even get that loan to work, thanks to the county, we were able to use the land and also able to get what's called, you'll see the BS, which doesn't stand for what you guys want to think that it stands for, but it's a Big Sky Economic Development Trust Fund and a Community Development Block Grant. And these two grants totaled $860,000. And with those two grants plus the land, the Board of Investments was happy because it was able to have the loan to value that it wanted to get to be able to do the loan. And that loan, I want to say the interest rate is probably about 4.76, 4.72. So that was how the county was able to purchase the building from DirecTV. And now the USDA, you'll see, before you can have a building, you have to have infrastructure. And the county land obviously matched that loan, that grant amount of $1.25 million. And so then we kind of hop on down. DirecTV, of course, paid for all the construction. They did everything within the 7 months, and they've put in $5 million worth of equity into their building and everything else that's in there. Recommend if you can get a tour of that building. It's really, really interesting. It's probably the foremost technology advanced buildings in Montana right now. 72,000 square feet. It takes a while to kind of get the tour through it. But then the county, of course, has offered $2 million in job credits, which Dick has kind of already explained. Now that $10 million won't be available for another 10 years until after the first initial lease is done. So when you kind of go look back and look at this, the state of Montana itself, and working with the Department of Commerce, they put about a total of $2.8 million into the project. And when you look at that, some people might say, well, a big corporation came in and all these big incentives got thrown at this corporation to come here. And when you look back and you analyze everything, that's really not the case. $1.9 million of these monies went to training grants. And when you look at training grants, the way that program works is, there's thresholds and there's accountability. And when you have the training grants for DirecTV, in order to even receive the funds, there's a training plan that has to be completed. The employees have to actually complete the training plan, and the company has to pay at least $13.99 an hour, including benefits, in order to be even eligible for this. So, there's some people that might argue, well, these jobs aren't really super duper high paying, but when you look at the whole scheme of things, the benefit package, which Dick will refer to more later, they've exceeded the $13.99 an hour to meet that threshold. So the other interesting thing about dealing with DirecTV is, they had a lot of other states that we were competing with that just said, here, we'll give you a $4 million contract right now for job training. And when we worked with the company and the state, it was pretty much a memorandum of understanding, and we can give you so much money this year, and then when we get more money, we'll give you more training dollars the following year. So that was just the total for all this was 1.9 compared to $4 million, of which I think it was either College Station or Oklahoma was offering the company. So as you look at the totals of everything down here, the total project being $23 million, 32% of it came from grants, 43% from loans, that's just the Board of Investments loan. The bonds, thanks to the county, was 4%, and then the equity of DirecTV is the 21%. So you kind of put all these things together, you learn a lesson in that you have different cultures that you're dealing with the company. This didn't take You know, this didn't happen overnight. This was a process. I started working for MADC, I think last September, and Dick said, welcome, here's a DirecTV project. We need your help. And so, you know, after a year later, we finally got it closed, thanks to everyone that was involved. You know, and when you look at this project, you obviously have impacts to not only the state, but also to the local economy. And when I'll go ahead and introduce Jessica Allred on that. And you know, you look at the impacts, you're going to see, you know, what's our return, what's going to happen to the city of Missoula, what's going to do this for this, what's going to happen to the state. And so we'll let Jessica introduce those numbers. Thanks, Jessica.
The numbers you see on the screen have been compiled by the CEIC. It's taken from a cost-benefit analysis that they put together. As Eric was explaining, the Montana Department of Commerce invested $2.865 million into the DirecTV project in year one. I use the term invested very intentionally, as you will see throughout the course of the next 4 years of the project. In year two, because of this investment, we had 323 construction jobs created with over $8 million in payroll. From that $8 million, $330,000 went back to the state in income taxes. In year three of the project, we have, after 2 years of the state's investment, 950 people will be staffing the DirecTV facility. And in addition to those 950 people, we have 522 jobs that will be indirectly supported by the facility. For those 1,400 Montanans, that's over $50 million in payroll money and over $2.2 million going back to the state in income taxes. So at the end of year three, the state is only $38,000 short of their initial investment. And at the end of year four, we are $2.4 million in the black. I think that this very much illustrates the fact that this was a great investment on behalf of the state. It was the state investing in Montana, the county working for Montanans. And I am going to turn back the podium to Dick for our conclusion. Thank you.
Thanks, Jessica. Now that we've had all that, I want to just some lessons learned. As Eric said, and as Jessica referred to, the commitment to DirecTV for job training was critical to the project. That funding is contingent on subsequent legislative approval. To their credit, DirecTV accepted a promise. The state workforce training program, which was created by the 05 legislature, was appropriated $2.6 million. And it can reimburse an employer up to $5,000 per qualified job created. Well, 5,000 times 800 is 4 million if we went all the way. So Eric's point is well taken here. The scope of the project overwhelmed the resources in Montana. So we worked with the Governor's Office, Department of Commerce, and worked out and with the company. They accepted part of their commitment this current biennium and agreed to a promise next biennium. So I'm here to tell you, when you see your legislator, tell them to fund the workforce training grant, because it's time for us to live up to our commitment in Montana, because the company has delivered on theirs. And it really raises the question, workforce training is a critical component for economic development, and we compete across the country. So is Montana willing to commit the resources, the money, needed to make that job training program dependable and workable across the state? If we can assure companies that the workforce they need will be available, we will have opportunity in Montana. Job training can also be critical for alternative energy development. In fact, it's absolutely essential. So along with the worker training, we should be talking about community colleges and COT expansion, but that's a subject for another day. The Workforce Training Grant Program is the one that, let's see here. So again, we had a team effort that was successful, but it stretched everyone to the limit. The incentive package that we're talking about was important, but so was the availability of the workforce, shovel-ready land, thanks to the county again, and evidence of commitment. And that took the county, the state, et cetera, federal level to convey that we were committed to make this work. Again, it's a promise, and the company accepted that. One other thing I want to throw at you is the company also considered crime rate, which was a positive. We'd like to get more data on that and talk to our friends in the sheriff's and the police office. Well, one thing we're seeing is so far about 60% of the people hired at DirecTV came from currently employed, already employed. The company has experienced about a 4% turnover rate so far. One of the reasons they're attracting employees from existing employers is healthcare. The company's healthcare plan, if you go to work, if I went to work for DirecTV today, I get on their healthcare plan February 1st. It's a California law. But when they move to Montana with their facility, their personnel policies remain the same. So there's no 90-day waiting period for healthcare benefit, and there's no out-of-pocket deductible. The copay starts from $1. Pretty good healthcare plan, and it's really made a difference. That's, when you look at the wage plus the benefit, I think we can talk about quality jobs. The team effort was a very rewarding effort. It tested everyone, but again, you get to cut or watch the ribbon getting cut, I guess is what you want to say. Again, I want to point out these are the key partners in the project: the State of Montana Department of Commerce and the Governor's Office, Missoula County, DirecTV is the company, and then the federal agency, the Economic Development Administration. So thank you all for your attention, and if you have questions, we'll be glad to answer them.
Dick, I just want to say that acknowledge your staff and the county for attracting such a great company. I'm all for all who can actually do business with DirecTV. I'll tell you, you cannot. They're great people, it's a great company, the value of the people, the employees. You can see there's a great group of quality people and quality company that you really tell a lot of their value to the community, to their own business, and the community, the promise.
Not that I know of, Walt. Thank you, Walt.
Thank you.
The point that Walt makes, I'd like to just follow up. As I said, this project put a lot of strain and effort on everybody involved, but if you're going to be in a tough race, it's great to have a good horse to ride.
Thank you, Dick. Is it short?
Yes.
Thank you.
Well, if we could not offer as much money as other states, initially, and there might be a lot of cooperation here, why did they choose? Could have been just low crime rate, right?
If we couldn't offer as many incentives, why did they choose Missoula?
Beats me. I think the answer would be, the question was why did they choose Missoula, given the fact that Montana doesn't have the resources that other states. Idaho, for example, funds their workforce training program at a level of 3 to 4 times what we do in Montana, and they write the contract up front. Idaho's not too far away. They chose Missoula for a couple of key reasons. One was they had focus groups that we put together for them, where we brought in prospective employees, and we put an ad on that on a Friday afternoon in August, and on Monday morning, 100 people showed up calling in interested. Those focus groups conveyed a message to DirecTV that the workforce here was attractive. So they felt, they knew that there would be changes. The unemployment rate's not high, but they felt the workforce would be excellent. And secondly, what are we called in the Rocky Mountains? We're called the Third Coast now. So many corporations are looking at communities like us and up and down the Rocky Mountains as an alternative to California or the East Coast. So that and many other things. But the incentive package, they told us all along, had to have certain components, and they really pressed us on the ability to deliver that. But it wasn't the only thing they took into consideration.
Thank you, Dick. I'm afraid I'll have to cut off questions there. I just want to comment, though, that this was an incredibly complex project. I watched it unfold, and it wouldn't have happened without MAEDC, without the county, without the governor's office, and without the federal involvement, and Senator Baucus in particular was heavily involved in this. I think it's going to be a wonderful thing for Missoula, and I thank you all. We want to now turn to a look at major industries and industry sectors in the state of Montana. We're going to have a small change in our program. Our speaker on agriculture has to be in Bozeman, so we're going to adjust the program and begin with a look at agriculture. But before I do that, I want to say how extremely pleased we are to have had for the last few years the cooperation of our colleagues from within the Montana University system, and I'm going to introduce them in a moment as they speak, but I would like to recognize their departments and units. I'd like to recognize the Department of Agricultural Economics and Economics at Montana State University, as well as their Ag Extension Center. I'd like to recognize the Institute for Tourism and Recreation Research in the College of Forestry and Conservation at the University of Montana. I'd like to recognize also the Montana Manufacturing Extension Center in the School of Engineering at Montana State University, and our Montana Business Connections in our School of Business Administration. As you'll see when you hear them speak, they are a tremendous addition to our program, and they bring you information and expertise that we simply do not have in-house. So to begin with a look at agriculture in Montana, I would like to introduce a professor in the Department of Agricultural Economics and Economics from Montana State University. Would you please welcome Vince Smith?
It's a real pleasure to be here, and of course I come from the wrong part of the state to actually pretend that that's true. But before I get into the agricultural outlook, I have to acknowledge, much as I hate to admit it coming from Montana State University, Missoula has at least 2 state treasures. One of my passions is women's basketball because I have 2 daughters. Unambiguously, Robin Selvig is a statewide treasure, and I hate to have to admit that, but he really is. My other passion, or one of my other passions, is economics, and a true state treasure is the Bureau and Paul Paulson, the director, and we cannot articulate to any adequate degree how much we appreciate working with Paul and the members of the Bureau. It is really a pleasure and a privilege, and I would like to thank him too. To the meat of what I'm here to talk about. Agriculture in Montana has been the staple and then a staple throughout the history of Montana's economic development. Starting with the railroads that enabled the effective production of grains throughout the state that could be marketed at prices that were worthwhile, through to today. Agriculture is very important to the state. It is one of the 5 or 6 pillars that maintain the state's economy. Without it, eastern Montana would not be a very successful area. Within the context of the state, farm and ranch cash receipts in 2004 and 2005 were well over $2 billion. And in fact, over the last 30 years, that's record levels. So the agriculture, as Paul pointed out earlier today, has been a part of the story of why we have had a boom over the last 3 years. For agriculture, it is a more tenuous contribution in the sense that we know that farm incomes are highly volatile. They're highly volatile because of the weather, We have drought, we have floods, we have pestilence, grasshoppers anyway. Quite biblical, really. We also have volatility in prices that are very important in both the grain sector and the beef sector. And wheat and cattle between them are the core of the agricultural economy in Montana, accounting for 75 to 80% of total farm cash receipts in every year over the last 50 or 60 years, and before that. What does agriculture in Montana look like? Well, it's changing. If I asked you, are there now more farms and ranches in Montana than there were 40 years ago, most of you would say no, and most of you would be wrong. In fact, farm numbers have risen by about 15% since 1982. But if I asked a different question, among the families who depend entirely or almost entirely on their living for farming incomes, what's happened there? The answer is that number has shrunk a little. We've seen a growth in small-scale operations where the family's income is largely from other places. You call them ranchettes and farmettes, I guess. Better than bravettes. But among the farms with relatively large sales, all of which, by the way, are family farms, we do not have corporate farms run by big corporations, period, almost. Though the ones that provide income for just one family or two families, where very little income comes from other sources, those numbers are declining because those farm sizes are increasing. Technology is a real important role. In addition, incomes available to people with those skills who are in farming outside of farming have driven lots of change too. I'm only going to be a farmer if I can be paid my opportunity cost, what I'm worth elsewhere. And so we've seen rising farm incomes, by the way. We have high volatility. In the context of where is agriculture going, the government, meaning the federal government, is critical. 15% of farm and ranch cash incomes come directly from government payments. Now, I might not approve of that as an economist, but as a member and citizen of Montana for the last 20 years, I'm darn glad that they get it, because it helps our economy tremendously. Here's a picture of what cash receipts and government payments in Montana look like over the last approximately dozen years. The largest component of farm income comes from livestock, 40 to 48% over the last 12, 15 years. About 30 to 35% comes from wheat. A small amount of income comes from other activities than beef, livestock, and wheat. And government payments are the other major source, about 15% on average. We've seen since 2002 improvements in gross receipts and in farm and ranch incomes because we have had A, higher prices, and 2, a change in the structure of government payments in 2002 that created a more stable flow of income from the federal treasury to the farm gate. If we look at production for all grains, which is approximately 80% wheat, 15% barley, and then a little bit of oats and rye and so on, we see a great deal of volatility. How much wheat or barley we produce in any given year is a function of two things: how much land is planted to those crops, and what the yields are going to be like on each acre in which we plant. If we look at planted acres, and we don't have that data up today, what farmers do today is conditional on what they expect tomorrow. Farmers planting wheat look at futures prices for when that wheat will be harvested, and when those prices are high, as they are right now, we'll see more area planted to wheat. Similarly for barley. When they're low, we'll see less. But planted acres have been relatively stable in this state for approximately 50 years. Most of the volatility in production from one year to the next comes from Mother Nature, from drought. This year we had relatively We had relatively low plantings in part because of low moisture content for winter wheat last year in 2005. And then we had dry weather, and so we have poor yields. We expect actually, as I'll show you in a few minutes, more wheat to be grown if we get average growing conditions. What about prices? Well, since 2002, prices have been relatively strong. From record lows in the late 1990s, we've seen prices strengthen, and particularly we've seen them strengthen in the last 2 or 3 years. This has been because global wheat production has been low. Prices for wheat, and by the way, prices for most of the crop commodities we produce are driven not by local but by global conditions. When we have lots of global wheat, we have low prices, and that was the case in '98. When we have relatively poor global production, which was the case this year, we have higher prices. Farmers do not control the price of wheat on average. The barley story is quite fascinating, and we don't usually talk about barley, but barley and corn are related, and corn is related to our energy policy. Currently, about 15% of the corn crop within the US is going for ethanol production, almost exclusively because of heavy government subsidies and government regulatory mandates for that program. And we've seen corn prices this year jump to record levels, record at least over the last 35 years. We're looking at $3.40 corn for a Yellowstone person who plants their irrigated acres to corn. Malt barley is losing out to corn in the Yellowstone Valley right now. Quite a fascinating development. And you can see a little strengthening in the all barley price. Feed barley prices this year were at record levels, and we expect to see some acres go out of malt barley into feed barley for this coming year, and a few acres go out of wheat into feed barley. These are futures prices for spring wheat. They're all high for next year. December prices, $5.30, $5.09, $3.92 for different, well, $5.30, $5.09 for different types of wheat on the two exchanges. For corn, a futures price of $3.92. If I had told you that that was going to be the price of corn 5 years ago, and you were economists who did agriculture, you would have metaphorically at least hung, drawn, and quartered me. But these high prices are a mixture of two phenomena. One, a relatively poor corn crop, and two, very substantial increase in demand for corn for ethanol. And that's what's going on there. What's happening with winter wheat? Well, we had sharper reduction in production this year, 13% down, but there were fewer acres seeded. We did have bad weather. Spring wheat was low. Even though more acres were seeded this year than last year, we just had rotten growing weather. Whoever it is who controls the weather didn't like us this year. It may have been climate warming, it may have been just God is angry with you personally if you're a farmer, but we had a tough time. I briefly talked about global wheat. This chart tells an important story. Firstly, it reflects back on the first speaker today. China's the biggest producer and biggest consumer of wheat. I actually don't quite agree with everything the gentleman said about the growth of beef demand in China. We're seeing radical change for people who move in China from the farm to the city. They change their consumption patterns overnight. Studies out of the University of Stanford show that very clearly. We're seeing very small increments in protein consumption, but if every citizen in a city in China increased their beef consumption by 2 pounds a year, that would mean that China as a whole would be consuming about 20% of what the US consumes in total beef. That's a lot. As one of my colleagues at Iowa State puts it, 1.3 billion people times any number is a lot. Even I can do that math. What's the global wheat market looking like? Well, we've had low production, we've got high prices. Right now, people are forecasting the same for the rest of for next year, for this next growing season, mainly because we've got low stocks of wheat globally. But we don't really know what the price of wheat will be, because what drives wheat prices is Mother Nature and wheat yields globally. So if we have a good growing year, prices will be much lower than we see in the futures market. If we have a bad growing year, they'll be about where they are, or a little bit higher. And when I say growing year, I mean in China, India, Europe, and the United States, not just in the United States. We expect feed grain production to remain stable. We expect to see an increase in, quote, industrial demand for feed grains, i.e. ethanol. And so we would expect to see strong corn prices, even with a relatively good year for growing. What else matters? Well, trade matters. We sell beef, when we're not accused of lots of BSE cows, around the world. It looks as though Japan's market and South Korea's market will be coming back for us. There are other markets that are beginning to open up. So trade matters for beef. Trade matters a lot for wheat. Out of Montana, we ship at least 70% of our high-quality wheats abroad. So foreign demand really matters. Do we have a stake in the WTO talks? Yes, they're suspended right now. But when I talk with my colleagues in Washington who work on the Senate and House committees, they all expect eventually, within the next 3 or 4 years, a new free trade agreement to be developed. And you're thinking, that's a long time, but the average time for a trade agreement from the idea of a new multi-country trade agreement to getting it done is 10 years. We're not as competent as the Montana and the Missoula Economic Development Council at getting big projects done. There is continued movement to free trade. Opening up of markets is a major goal for U.S. trade negotiators. For exports of wheat, our exports have remained between 25 and 30 million metric tons. Every time we produce more wheat, we export it. Domestic consumption of wheat is incredibly stable in this country. It's not growing more than about 0.5% a year, only driven by population. For Montana, we had modest production last year because of weather. We expect more production this year. We've got more acres planted, and we expect better weather on average. On average is a nice cop-out for an economist. So we do expect wheat prices to remain relatively high unless there's a very strong production year. But strong production years occur quite frequently. So do we know what the price of wheat will be? No. Would I gamble on the futures market? Well, my wife won't let me gamble on anything, so no. Would you? Probably not. There are better investments. What about the cattle market? Well, cattle prices have been very strong for the last 4 to 5 years. In fact, at record levels. But very gradually, we're seeing cattle inventory within the U.S. creep up. That does matter. The more cattle we produce in the U.S., the lower the price will be. So we are seeing inventories begin to rise. But the price story is a little complex. As you can see from this slide, since the mid-90s, when, to put it bluntly, cattle prices were in the toilet, we've seen a steady strengthening of those prices to record levels last year. These are prices for feeder cattle. This year, we've seen weakening of those prices. Why? What's happened to the price of corn? It's gone up a lot. And what do our cattle do? Well, they don't go straight to the plate. They go straight to the feedlot. And feedlot costs have gone up. So we've seen corn prices knock down cattle prices for feeder cattle quite substantially. That's not what's happened to fed cattle prices, by the way. They've remained fairly stable, but the margins have expanded between the fed and the feeder cattle price because it's more costly to feed up our feeder cattle for market. What do we see in the futures market? Well, for feeder cattle, we see some strengthening of prices. The assumption, we're not quite sure why, to tell you the truth. Some people believe corn prices will moderate a little because high corn prices today are encouraging an expansion of the planting of corn. Not really more acres in Iowa, but more acres in North Dakota and South Dakota as the Corn Belt gradually moves west, partly because of new varieties of corn that have come online that have shorter growing seasons. What are the cash receipts done? Well, they were up slightly from in the US from $49.2 billion to $49.7 billion. We expect export demand to strengthen a little bit. What about domestic demand? Maybe remain stable or slightly decline. We're having a hard time explaining exactly what's going on there. A lot of it is driven by perception of health effects of beef. We know we've got higher feed prices, so I'm somewhat skeptical about feeder cattle prices strengthening much beyond where they are now if corn prices remain high. Farm Bill, well, that's political. I'm not very good at forecasting. What I tell my students are the animal spirits of politicians, with apologies to several of you who are politicians in the room. We do see that the Democratic parties in both the Senate and the House are advocating an increase in spending for farm programs in a variety of dimensions. Much of that increase is likely to come in the form of increased subsidies for energy-based agricultural production or processing of agricultural commodities. We have the administration wanting to halve spending on farm programs. So we have a conflict between the administration and the Democrats. Where are the Republicans in the Senate? They're conflicted. If they're from a farm state, they want more, and if they're not, they want less. Very understandable. It looks like there's widespread agreement, though, that subsidies will increase if there is a new farm bill. Likely the new farm bill will look quite like the existing farm bill, but with add-on programs in the bio-based energy area. In addition, fruits and vegetable producers have realized they don't get a whole lot out of the farm bill. They're lobbying for an increase in payment, and the estimate is they'll get an additional $2 billion to shut them up and make them go away back to California. I know that's not a politically correct way of putting it, but never mind. And if you have any questions, I'll respond to what, Chuck? 1, 2?
Let's see how many we have then.
Okay.
Questions, comments about agriculture? Yes?
There's great interest throughout the state in on-farm and small-scale production of bio-based energy sources. In order to produce biodiesel on the farm, you would have to raise an oil seed. A camelina is a new crop they're looking at. Safflower, sunflower, canola is the other one. No one in their right mind will sell safflower for processing into energy because they can make a lot more money selling it for birdseed or whatever. But if the question is, are we seeing an expansion of acreage? The answer is not really. We plant about 6 million acres to crops. Oil seeds account for less than 150,000 of those acres. That's a small percentage. New oil seed production is no more than about 20,000 in terms of, say, camelina and other completely new varieties. Farmers are cautiously just experimenting with these crops on small acreage so that their risk is very limited. We're not quite sure what the marketing mechanisms will look like. There are some cooperative enterprises where, for example, you can sell your crop, but marketing is a big deal. And for these crops to be grown by farmers, they have financially to be a better deal than wheat, just to be blunt about it. And right now, farmers are not quite sure about where that is. Several groups are working to provide farmers with education too. In a sense, Farmers, when a new crop comes along, they need job training programs. And the governor has a major initiative called the WIRED program to provide that sort of job training for that sort of enterprise. But we're not seeing expansion right now.
Thank you, Vince. Would you please welcome Norma Nickerson?
Thanks, Chuck. Appreciate it. How's everybody doing? Can you see back there? Because if you can't, there's still some seats up here and they can see really well. Thanks, Julie. Okay, so I am going to talk to you about the industry that I find pretty exciting, and I say this every year because usually when people are out traveling and recreating, they're having fun. But one of the things that we get a lot of questions on is related to gas prices, and every time there's a spike in the gas prices, when you go to the pump, the reporters start calling the Institute and say, oh, what's going to happen to the travel industry? And every time they call, I say the same thing. When you shut the valve off and there's no more fuel for people to put in their gas in their tanks, that's when we will see a big change in our travel. But until that happens, you are still filling up your tank, you're still going out traveling, and you're still doing your recreation. But with that said, you look at this chart and you see that, basically since 2002, it's been going up drastically. And then I put up there griping about gas prices, and in your Outlook seminar book, I put quit griping about them, because if you look at it inflation-wise, the last number on there is in September, and it was $2.60. And it already has gone down, so you're happy right now, so I probably don't even need to talk about this. But I can guarantee you it'll probably go up again once June comes around. But anyway, if you inflated the prices, from 1980, you were paying $3.15 to fill up your gas. I mean, that's what you're paying per gallon. And it cost you 105 minutes of your work day to travel 100 miles for that gas tank. And now it's half that amount of time that you have to work. So in the big scheme of things, we're not paying as much, and you still have extra money. And I think that's one of the reasons too why people are still traveling, even though we like to gripe about those things. When you look at, though, what the non-resident visitor is spending on gas compared to all the other things they're spending their money on, you'll see that 28% of their dollar is going into gasoline. And then it goes to restaurant and bar, retail sales, and fourth on the list is hotel, motel, and most people think that's where the majority of the money is going. Now, like Vincent said earlier, averages are whatever they may be. This is an average non-resident visitor. It is not, it includes somebody who's passing through. It includes people who are staying at your house, and includes people who are camping. So most of those people aren't going to motels and hotels, but they are spending money on gas, and they have to eat. So that's why there's some differences in there. When we look at it, though, what we see is the average spender is $143 a day. You look at the people who are vacationers, who are here primarily for vacation, and they're spending $183 a day. And visitors who are here in business or conventions are spending $145, and so on. And those passing through, no surprise, are only spending $96 a day. The interesting piece of this is that 34% of all non-resident visitors, and by the way, that's 10.1 million non-residents coming into this state, are here primarily for vacation. But when we did our last survey in 2005 compared to 2001 of the non-residents, the vacationer market has shrunk by 7%. And as the volume of non-residents go up, which they have been every year, and the vacation number is going down, we're actually losing vacationers to this state in the big picture of non-resident visitors. And when you look at what they're spending, if we keep dropping the number of vacationers, that economic impact is going to start dwindling a little bit as we go along. Where's that money drop, though? When you look at this is the 6 travel regions that Travel Montana uses to promote the state. And you'll see that Glacier Country and Yellowstone Country, which is probably no surprise to most of you here, is where 60% of all non-resident dollars are dropped in this state. And then it's followed by Custer Country, which obviously is Billings. That's hauling in the money right there. And the rest of the state, they're going around, they're not spending as much time, nor are they spending as much money there. So it's a very valuable asset to this part of the state of Montana. How much dollars are we talking about? $2.7 billion in direct expenditures from their pocket into your pocket, the non-residents, new money's coming in, which is 34,500 direct jobs. When you combine all the indirect and induced, you get 46,000 jobs that the non-resident industry is supporting partially or fully. 143 million of that is in direct state and local taxes, and 202 million in combined taxes that they are providing to our state because they came here to visit. So what are the trends? As I mentioned earlier, it's been going up, it continues to go up, it's been pretty nice and gradual, 2%. In the early 90s to about 1995, it was a larger growth rate and people were panicking. What are we going to do with all these people? We don't want them all here. And then the growth rate slowed down and you got used to it. And so it's looking good, and it keeps going up like that. Two of the big indicators, Yellowstone and Glacier National Park, both had an increase this past year. That's not the case with all national parks around the country. They've been seeing some declines. But Glacier and Yellowstone, they've been going up and down as well, but they had a very slow but gradual increase in recreation visits this past year. This is an interesting slide. Last year, if you were a skier, snowboarder, it was great snow. And everybody in the state, almost all the ski areas, had great snow, so you all went skiing, non-residents came, and there was a great skier. The year before that, as this chart shows you, it was not a good year. This year is questionable. There's some areas that are doing okay and some areas that aren't doing okay. But when I look at this chart, I had the privilege of listening to Steve Running, who's an ecology professor in the College of Forestry and Conservation and the director of the Montana Climate Office. And I listened to his little speech, and now I look at that and I go, I think this is going to happen more and more. We're going to see, and at the ski areas, ups and downs that are quite drastic like this. And part of that reason is, as Steve would say, there is a climate change going on, and it's starting to show up. He's suggesting that in 50 years, and I've had to clarify this with him to make sure I'm not lying to my audiences out there, but that in 50 years we potentially could have no more skiing in the state of Montana. Yeah, we might have years that are a little bit better than others, and there would be some skiing, but in 50 years, basically, I wouldn't want to be in the ski business because it's not going to be a sustainable business for any of those folks. In addition to that, with the ski area, that means there's not a good snowpack, and what Steve is saying is that the snowpack is melting 3 weeks earlier. When you have the 3 weeks earlier melt, you've noticed, we've all noticed here, if you like to fish, that we've had to close down, or Fish, Wildlife, and Parks has had to close down to you fishing like on the Blackfoot River during the day. Go early in the morning, go later in the day, but don't go fishing and handle those fish in the middle of the day because they can't handle that. The waters are too warm and they're too low. There's not enough water there for those fish to be healthy. And so those are the types of things that snow level is also doing, which directly affects the non-resident visitor as well, because fishing is a big component of it. And then to top it off, when your snow melt is going away 3 weeks earlier, it's drying out higher in the elevations of our mountains, which is allowing forest fires to go in places that haven't been there before. And those are the types of things that do affect non-resident travel. So that sounds kind of like a gloomy forecast, but those are just some realities that we're starting to see that are occurring here. But let's go on to another little topic. I mentioned hotels. They aren't the big player in the tourism industry, but they're an important player. Last year, in 2006, there was a 5% increase. The mountain region had a 3% increase, so we actually outpaced them, and that's kind of amazing when you think that the mountain region includes Nevada, which I think Las Vegas, probably one casino has more hotel rooms than we do in the entire state. So that's pretty amazing. Air traffic, I haven't had this kind of a graph ever since I started doing this in 1995, we actually had a statewide decrease of 3% in air traffic to Montana. Why is this happening is, as you know, the airline industry has had a lot of difficulties, especially since 2001. But to deal with those difficulties, they've reduced the size of the airplanes coming into Montana, so there's fewer seats. And when there's fewer seats, our non-residents and us aren't able to fly in and out as easily. Interesting, though, when you look at this chart, is Missoula is the only one on the upside, where they had a slightly over 1%, 1.6% increase. Billings was basically level, and all the other cities in this state had a huge decrease in deboardings in their communities, and that's why, hence, we had a 3% decrease. Billings is the largest airport in terms of number of planes, followed by Bozeman. So when Bozeman goes down, that's why the state is showing up as a decrease. And then you add the other ones in there. So what are we talking for an outlook? The United States is saying domestic travel is supposed to increase about 2%, a nice easy number that we can put out there. We're expecting the same thing in Montana. We generally follow what's going on around the country, and I expect that to happen again. When we do our industry questionnaire to those folks out there, they have been saying that it's looking like a good year. They expect an increase, not a huge one, but they're feeling very confident about it. And then I put that little part in there in red because I haven't mentioned this, and how can you make a summary without saying, or putting something in that I haven't mentioned. But the baby boomers, which I am in part of that group, are slowly becoming or empty nesters. They still are working, but they don't have kids at home. As those kids finish college, they all of a sudden have the money. And they have the time because they've been working for a long time, and they have vacation time coming to them. And so that's why we believe that travel is going to continue to increase in a nice volume of 2 to 4% every year. And I'm putting my neck out and saying that's going to happen for at least 20 years. Because the baby boomers will be out there, they will travel, they're healthy, and they've got the money. So we think it's going to be a good year and a good future for non-resident travel. And with that, I'm going to open it up for questions. I do want to mention that we put out our biennial report, and it's out this year. There's a few out there on the table, and if you don't get to have one in your hands today, you can download it from our webpage, which is there, and all our reports are always available to you on our webpage. So thank you.
Thank you, Norma. Questions? Questions, comments for Norma?
I have one.
Yes.
Can you distinguish between a destination, non-resident, and just a traveler?
Can we distinguish between a destination traveler to Montana and just a regular traveler? Passing through? Yes, we can.
Do you do that?
27% of all non-residents in this state are just passing through. 34% are strictly here on vacation. 19% are visiting all you folks and everybody else in the state. I think it's 13% are on business, and the rest are other, which is coming for funerals and medical and shopping and things like that. Any other questions?
Other questions for Norma? Yes.
Good morning.
Good morning.
Hypothetical question. If a mayor were interested in a low-lot sales tax, that would, in effect, require visitors, non-resident travelers, to his or her community to pay a portion of the cost of infrastructure and services within that community. Do you have research that suggests that those visitors would be averse to, say, a 2% tax? Would there be an adverse impact on the economy of that community? And do I need to leave the room quickly?
No. You do not need to leave the room quickly at all. Hypothetically speaking, visitors, everywhere else they go, they pay taxes. And they're used to paying a sales tax. And the one thing we get on our questionnaires is, whoa, you don't have a sales tax. And they're pleasantly surprised. And then the other side of them says, I don't know why you don't have a sales tax. So is it going to keep people out? No. The ones that people, we're just not used to it, and we like saying we don't have a sales tax and we don't want to pay those extra pennies. So I think it's the residents that are struggling with it, and the non-residents aren't going to at all. In New York City, they had, with their hotel tax and all the other taxes that they added on, at one point they were paying 21% on a hotel bill. And that started reducing conventions and businesses in New York City, and they lowered it down to about 17%. So it sounds like 17% is the threshold. If you go above it, people are going to say, I'm not going there anymore.
If the Bureau ever starts to worry, I'll come see you, will you?
No problem.
Thank you, Norma,
Thank
very
you.
much.
I think she's a long way from wearing us out, John. That doesn't mean she shouldn't come and see you.